Welcome to another deep dive. If you are listening to this right now, chances are you've been feeling that familiar, creeping sense of whiplash that seems to hit all of us lately.
Oh yeah, it is definitely a daily thing at this point.
Right. You look at the news, and the pace of change, the intersection of AI and finance, isn't just accelerating week by week anymore. It is happening daily.
Hourly sometimes.
Exactly. You have massive institutions throwing around predictions of mass industry disruption, the crypto markets are swinging wildly, and new AI tools are dropping faster than anyone can reasonably test them.
It is exhausting.
It really is. It can feel incredibly overwhelming, almost like you're expected to outlearn every single new tech release just to keep your head above water. But what if the secret to surviving this shift isn't about learning 100 different tools, but rather mastering just one entirely new skill?
That is the exact premise we were looking at today, and it represents a pretty powerful pivot in how we need to think about the future of work and wealth. We are moving away from the panic of trying to keep up with every single software update and moving toward a strategic repositioning of how you interact with capital, technology, and risk.
And to guide us through this, we are pulling from a really compelling stack of sources today. At the center is an op-ed by Saad Naja. It was published on March 6, 2026, and it's titled, "Managing Financial AI Agents is the Only Skill You'll Need to Survive the AI Layoffs."
A very bold title.
Definitely. And we are also layering in a research report from CoinDesk on the Pudgy Penguins brand, which is essentially rewriting the rules of global intellectual property and retail.
Which sounds completely unrelated, but I promise it connects perfectly.
It really does. And to ground all of this in reality, we have a thick stack of late-breaking market headlines from early March 2026. We are looking at major movements in Bitcoin, the explosion of prediction markets, and some serious global regulatory shifts.
The diversity of these sources is what makes this specific analysis so vital. I mean, we are looking at theoretical frameworks for AI, real-time market volatility, and tangible shifts in consumer products.
Yeah.
And despite how disconnected they might seem on the surface, they all point toward the exact same underlying macroeconomic trend.
And our mission for this deep dive is to weave all of those threads together to give you a cohesive playbook. We want to distill these sources so you can actually future-proof your finances. The goal here is to help you stop being a spectator in the stands, just watching the markets move, and to help you step into the role of a coach on the field. Okay, let's unpack this.
Let's start with the central thesis of the op-ed. The backdrop here is widespread anxiety. The analysis points out that Goldman Sachs has explicitly warned about AI-fueled layoffs across various sectors.
Right. Nobody's really immune.
Exactly. We've also seen Citrini Research put out a brief job displacement scare that actually sparked a massive AI trade. It is a very clear signal of the scale of disruption we are currently facing. The sources even reference a piece by Matt Schumer called "Something Big is Happening," which argues that in this kind of environment, extreme adaptability might be the only durable advantage you can possibly have.
But the op-ed argues that our standard human reaction to this anxiety is completely backwards. Our instinct is to scramble. We think we need to learn how to prompt engineer or understand the underlying architecture of the latest language model or master every single new user interface.
Which is a losing game.
It is. But the real solution proposed here is to focus on mastering AI skills that actively build a financial buffer. You need to build a nest egg to insulate yourself from the very disruption you are worried about.
Which brings us to the core concept, managing financial AI agents. And we need to be very clear about why sticking to the old way of doing things is so dangerous. The opportunity cost right now is massive.
Huge.
The greatest financial risk isn't experimenting with AI, it is doing nothing. The cost of ignoring these agents isn't just about missing out on outsized returns, it's about remaining entirely reactive. It's being paralyzed by the news cycle or passively paying high fees to human fund managers, while the window for you to capture these gains gets narrower by the day.
Let's look at how people are currently trying to adapt. Because it's so easy to fall into the trap of thinking we're utilizing AI when we really aren't. The data in our sources is actually pretty revealing.
It's a bit of a reality check.
Globally, according to eToro, 19% of people are now using AI tools to build or adjust their investment portfolios. In the UK, Lloyd's Group reports that 39% of Brits are using AI tools for future financial planning.
Those are big numbers.
They are. Now, on the surface, that sounds like massive adoption. It sounds like everyday people are getting ahead of the curve. But are those 39% of people actually doing what they're supposed to be doing?
What's fascinating here is how they are actually interacting with the technology. The analysis points out that many of these self-described financial use cases essentially amount to treating an AI chat interface like a magic 8 ball for money decisions.
Yes, exactly.
People are logging onto ChatGPT and asking it for incremental, do-it-yourself financial advice. They type in prompts like, should I buy this stock today? Or is this a good time to sell my crypto?
Right. They are treating the AI like an oracle rather than an execution engine. And the sources are emphatic that asking an AI for incremental advice is not going to deliver exponential gains. For that, you need disciplined execution. And that requires a total rethink of where human judgment actually adds value in the investment process.
Exactly. There needs to be a very clear division of labor. Humans need to play to our inherent strengths. We are the ones who should be defining the overarching investment goals. We should be thoughtfully allocating capital based on our specific life circumstances, setting firm risk constraints, and ultimately deciding when to intervene or pull the plug.
The big picture stuff.
That high-level strategic oversight is what humans do best.
And then we leave the actual heavy lifting to the AI. AI is best at executing trades with absolute discipline and absolute precision. Because if we look at the data, humans are frankly terrible at execution. The source material highlights a staggering statistic. 84% of retail traders lose money in their first year of trading crypto. 84%.
And there is a crucial observation to be made about that failure rate. Those retail traders aren't losing money because they lack access to information. In the modern era, financial information is ubiquitous.
It is everywhere.
They are losing money because they lack discipline. Human beings are emotional creatures. We hesitate when we should act. We get bored. We panic during a sudden dip. We impulsively revenge trade after taking a painful loss.
But wait, if 84% of retail traders fail because of human error and emotion, wouldn't that same human error just transfer over to how they set up and program their AI agents? Why shouldn't they be just as terrified of deploying a bot they manage themselves?
That is a very fair question, but it conflates the strategy phase with the execution phase. Setting a long-term rule like sell if this asset drops 10% is a logical, strategic decision made in a calm state of mind.
You make it over coffee, not during a market crash.
Right. The failure happens in the execution phase. When the asset actually drops 10%, the alarms are flashing red and the human trader freezes, hoping it will bounce back. An AI agent doesn't freeze. It doesn't need to sleep. It doesn't panic. It just watches the market 24/7, spotting risks, debating strategies internally based on your initial rules, and executing without a single millisecond of hesitation.
And the results of that cold, calculated discipline really speak for themselves. The op-ed points to a specific example, an AI quant hedge fund called Ningbo's High Flyer. In 2025, they disclosed an average return of 52.55%. That placed them right at the absolute top of the industry's leaders.
That kind of return is staggering, and it highlights the massive structural edge AI has in execution. The profits in these markets are often won and lost in milliseconds in environments where the margins are incredibly razor-thin. Human reaction times simply cannot compete.
No way.
This is why the argument is that agent selection and management will be the defining skills of the next decade, completely eclipsing current trends like prompt engineering.
To explain how you actually manage these systems, the op-ed uses a great analogy. It suggests we need to think about trading AI agents less like a fantasy football draft that you throw together based on media hype, and more like owning and managing a real football club.
I love this analogy.
It worked perfectly. You are putting real capital on the line, so you have to build a squad that is mathematically designed to win across all different types of market conditions.
And the specific roles in that football analogy map perfectly to distinct financial strategies. For instance, you might deploy one agent as your striker. This is an algorithm specifically trained to capture momentum. Its entire job is to aggressively push for gains when the market is clearly trending upward.
But you can't just field a team of 11 strikers, or you'll get wiped out the second the market turns against you. So you also need your disciplined defender. That agent is looking for mean reversion, essentially acting as a stabilizing force that steps in when prices drop too aggressively and sells when they artificially spike, betting that the asset will eventually return to its historical average.
And you certainly can't forget the quiet midfielder. This is an agent operating entirely in the background, constantly scanning for arbitrage opportunities. It is looking for tiny, fleeting price differences for the exact same asset across different global exchanges, allowing it to lock in risk-free profit and keep the returns flowing steadily.
But just like a real manager, you can't just put the players on the pitch, walk away, and hope for the best. The sources emphasize the absolute necessity of strict boundaries. You have to impose hard constraints on these agents. You must install kill switches to instantly halt trading if certain parameters are breached. You need position caps so one overly aggressive agent doesn't accidentally over-leverage your entire portfolio, and you have to actively verify your stop-loss controls.
Here's where it gets really interesting. We're rapidly moving toward a future where these agents won't just be making wild, unverified claims about their trading abilities on social media. Soon, they will be ranked against transparent, standardized
Like
benchmarks.
a real league table.
It will function exactly like a professional league table. The performance numbers will be publicly audited, and your primary job as the human will simply be to scout the best talent for your specific risk tolerance.
Which means the real risk for you listening to this right now isn't letting these agents compete on your behalf. The real risk is waiting too long. If you wait until the institutional players have completely saturated the market with their own agents, the inefficiencies will disappear, and the profit margins will compress to zero. You have to take your place in the coach's box now while the window is still open.
And if you want to know where this high-speed game is currently being played at the highest level, the sources point directly to the crypto markets. The analysis calls crypto the 24/7 on-chain proving ground for these agentic systems.
Because it never closes.
Exactly.
Ah.
It is the perfect environment for speed and discipline to compound, mostly because it operates entirely on-chain, meaning every transaction is public, verifiable, and instantaneous, without waiting for a traditional stock exchange to open its doors at 9 a.m.
So let's take a look at what is actually happening in that proving ground right now. We have a stack of headlines from early March 2026. And it paints a picture of a market that is moving incredibly fast with a ton of underlying volatility. For example, we are seeing reports that Bitcoin whales, these are the massive institutional-level holders, are actively selling their positions into retail buying.
Which, in traditional technical analysis, is widely considered a deeply bearish signal. The smart money is taking profits while everyday retail investors are buying at the top. And we are seeing that bearish pressure actually play out in the price action. Despite having its best week of Wall Street news in months, Bitcoin simply could not hold the $70,000 support level.
It is showing real weakness. In fact, on March 7th, one investment firm put out a stark warning that Bitcoin could crash by another 30%. They cited the strengthening historical gravity of its four-year cycle as the primary reason for the potential drawdown. And it's not just Bitcoin either. The headlines show XRP slipping as traders anxiously watch to see if the $1.35 support level will hold.
Now, put yourself in the shoes of a human retail trader. You are watching those numbers flash red on your screen, you are reading headlines about a 30% crash, and your portfolio is shrinking in real time. Panic is almost inevitable. You are incredibly likely to sell at a loss just to stop the pain.
But for an AI agent programmed with strict risk parameters, a 30% drawdown isn't a terrifying event, it is just a mathematical condition. It manages the dip according to a predefined strategy, completely devoid of fear.
Precisely. But the volatility in this space isn't just coming from the pricing charts. We also need to look at the broader macro environment, because the global and regulatory landscape is shifting under our feet as we speak. Just look at the regulatory developments in the U.S. Coinbase has recently come out sharply criticizing new U.S. tax reporting rules for crypto, calling them cluttered and confusing.
That kind of regulatory friction makes the operational side of crypto highly unpredictable for everyday users. And the political signals are highly mixed too. The sources highlight that, on one hand, you have the Trump administration explicitly vowing to support the security of cryptocurrencies and blockchain technology in its latest cyber strategy.
But, on the other hand, the highly anticipated U.S. Bitcoin reserve order, which many in the industry cheered a year ago, has basically languished without any real action. And the regulatory enforcement arm is still actively policing the space. Just on March 5th, the SEC and Justin Sun finally reached a settlement over the long-running Tron lawsuit. So you have this constant grinding push and pull in the American market between technological innovation, complex regulation, and active enforcement.
Meanwhile, the rest of the world isn't waiting around for the U.S. to figure out its policy layer. A new report shows that in 2025, crypto user growth in Latin America outpaced the U.S. by 3 times. What does that massive shift in the center of gravity mean for the market?
It means that the demand for borderless, decentralized finance is accelerating globally, often in regions that are looking for alternatives to their local financial infrastructure. And the underlying technology itself continues to prove its immense utility at an institutional scale. For instance, Circle recently moved $68 million internally in just 30 minutes using its own stablecoin.
Dude, 30 minutes?
Try executing a $68 million cross-border transfer with a traditional banking wire on a weekend. It simply isn't possible.
That speed and structural efficiency is exactly what these financial AI agents will be leveraging. But what is truly mind-bending is that these agents aren't just going to be trading standard digital tokens or equities. The sources point to a massive expansion in exactly where this automated disciplined capital can be deployed.
Let's bring in the report from Edward Ridgely about the evolution of prediction markets. We have discussed platforms like Kalshi and Polymarket before. Historically, the mainstream perception was that these were just novelty platforms, places to place sports bets or wager on election outcomes.
Right, highly speculative.
But the landscape has totally shifted. According to the Wall Street Journal, these platforms are currently in fundraising talks, seeking valuations of $20 billion.
$20 billion. That is not a niche gambling sector valuation. Ridgely's report explains that this massive influx of capital is driven by a shift that is turning prediction markets into professional hedging tools. Traders are actively using these platforms to place unpriceable geopolitical and policy risks that standard financial tools simply cannot handle.
If we connect this to the bigger picture, the mechanics of this are revolutionary. Imagine a traditional equity portfolio that is heavily exposed to international supply chains. A human manager might struggle to quantify the exact financial risk of a sudden geopolitical conflict breaking out.
It's too abstract for traditional models.
Exactly. But an AI agent can scan global news feeds, identify the rising geopolitical tension long before it hits mainstream equity markets, and instantly buy a contract on a prediction market related to that specific conflict. If the event happens, the traditional stock portfolio might drop, but the prediction market contract pays out, perfectly hedging the loss.
That is the exact level of sophisticated cross-market coordination the op-ed is talking about. Okay, so AI agents are dominating the digital space, optimizing latency in crypto, and pricing abstract geopolitical risks on prediction markets. But does this relentless optimization actually apply to traditional physical industries, or is this strictly a screen-based phenomenon?
It absolutely bleeds into the physical world, and this might be one of the most unexpected insights from our source material. We have this deep research report from CoinDesk detailing the rise of the Pudgy Penguins brand. For context, this started entirely as a digital asset, but they have now completely disrupted the traditional, stagnant, $31.7 billion licensed toy industry. And they are doing it with a model that directly challenges legacy retail giants like Disney and Pokémon.
The mechanics of how they are executing this disruption are brilliant. The research highlights their use of a negative CAC model. Instead of paying traditional customer acquisition costs, spending millions of dollars on social media ads or marketing campaigns just to get a single new user, they flip the script entirely.
They're treating physical merchandise, the actual plush toys you buy in a retail store, as their primary user acquisition tool. But instead of the marketing costing them money, the physical merchandise itself generates a profit. So they're essentially getting paid by the consumer to onboard that exact same consumer into their broader digital ecosystem.
And it is working at a staggering scale. The report notes they have already sold over 2 million physical units through various global partnerships and retail events.
It is a perfect example of a phygital model seamlessly bridging the physical and the digital. And while it might seem like a massive leap to go from discussing AI quant funds and prediction markets to talking about licensed plush toys, it is actually part of the exact same macroeconomic trend.
It's all connected.
Every single inefficiency in the global market is being targeted, whether it is the latency in a Bitcoin trade, the unpriced risk of a geopolitical event, or the bloated customer acquisition cost in the traditional toy aisle. It is all being relentlessly optimized by new technologies and fresh capital strategies.
So what does this all mean? If we bring this entire discussion full circle back to the opening argument, the global market is simply moving faster than human cognition can process. You have crypto swinging wildly on institutional whale movements, complex geopolitical hedging happening in real time on multi-billion-dollar prediction platforms, and legacy physical retail models being rewritten overnight.
It's a lot to take in.
The sheer volume of data and the raw speed of execution required to capture wealth in this environment is rapidly moving beyond the capacity of any individual human sitting at a laptop.
The overarching takeaway is very clear. Your anxiety about AI disruption is entirely valid, but the proposed solution of trying to outlearn the technology yourself is fundamentally flawed. You cannot outcompute an algorithm, and you certainly cannot out-execute one.
Exactly. You don't have to be terrified of AI taking your job if you learn how to actively harness AI to build your own capital. The mission for you, the listener, is to stop asking ChatGPT for simple, incremental stock tips. Stop treating it like a magic 8-ball. You need to start looking at the market like a manager. Start researching these agentic systems. Start thinking about how to build your own financial football club of specialized, highly disciplined AI agents to navigate this overwhelming complexity on your behalf.
This raises an important question, though. We have spent this entire deep dive discussing the massive structural advantage that AI agents have over emotional, undisciplined human traders. But as the analysis suggests, markets will increasingly begin to trade themselves.
Right.
So what happens in a few years when the human spectators leave entirely, the stands are empty, and the market is composed almost exclusively of AI agents trading against other AI agents? Does the market finally become perfectly, flawlessly efficient, pricing in every single global variable instantly? Or do the algorithms, in their relentless, automated quest for an edge, start trying to psychologically manipulate each other, creating entirely new forms of synthetic volatility that human beings can't even begin to comprehend?
That is an incredibly wild thought to leave on. A global market of autonomous machines trying to outbluff each other at the speed of light. Thank you so much for joining us on this deep dive. Keep exploring these concepts, stay curious about where this technology is heading, and maybe start scouting for that first striker AI agent for your own squad. Until next time.